Our banking practice uses a proprietary survey to gather data on trends and challenges affecting major banks in the United States. This year, there were a few surprises, a few findings that validate our thoughts on issues reshaping the industry, and there were a few areas where matters remain unchanged from years past. Well, who did we survey? We polled 100 CEOs, bank presidents, and other C-level officials from the largest 70 banks in the country. These banks hold about 80% of the country's total banking assets. We analyzed the responses as a group, but we also examined the responses by dividing the population into three tiers. The first tier was the very large banks, those with assets in excess of $250 billion. Second tier were those with $50 billion to $250 billion in assets, and the third tier were those with between $20 and $50 billion. So some of the key findings. The findings can be grouped into a few broad areas. First, the need to grow revenues. Next, the imperative to enhance customer experiences through alliances or purchases of agile financial technology. And the ongoing costs and complexity of banking regulation also dominated the findings as a third group. So let's start with revenue growth. When we wanted to know their expectations for revenue growth in the next 12 months as a group, there was a range of expectations. 30% expect revenue growth to be in the 6 to 10% range. Another quarter, 25%, said it would be in the 1 to 5% range. But another quarter predicted growth could be in the 11 to 20% range. What was very interesting was the largest banks expected the slowest revenue growth rate. 43% of that group expected it to be no higher than 5%. Half of the middle tier, the $50 billion to $250 billion, say they expect it to be about as much as 10%. And about half of the smallest banks in the survey are most confident, expecting growth to reach anywhere from 11% to 20%. On the issue of fintech or non-bank competition, just under 40% of the entire group said they consider fintech a significant threat to the industry. But the bigger the bank, the more the threat was felt. As a result, nearly half already are collaborating in some way with fintech, and another 16% on top of that said that they are seriously considering such a move. We believe the motivation for these moves clearly is to counter the attack by small, more agile fintech firms who very often are offering better customer experiences than traditional banks. And finally, on a related note, the issue of the effect of culture on the willingness to change. When asked about the acceptance of innovation and change in their institution, only 1/3 of the group said innovation and change is always embraced at their institution. They said change is often hampered by a fear of upsetting the status quo, an unwillingness to act because they felt they had too little information about how the proposed change would benefit the organization, and then there were many who cited turf protection attitudes. This 2016 survey reinforces our point of view that many of the larger banks in the US still have some ground to cover in the imperative to enhance customer experiences if they hope to boost revenue, which has been relatively flat for some time now, and add to the bottom line. Moreover, they are running headlong into an expectation by both commercial and retail customers who are demanding a user experience that reflects the way they are treated by other industries. We invite you to read our survey report and examine the numbers, and we invite your comments.